Good morning, everyone, and welcome to the May 2025 meeting of the Lextran Pension Committee. We'll call to order with the roll. Mr. Watkins.
Here.
Mr. Scheininger.
Here.
Ms. Falconberry. Here. Mr. Dial.
Here.
We do not have quorum, so we will postpone the approval of minutes until quorum arrives. We expect that Laura will be here shortly. So we'll go ahead and move to our fund performance report with Mariner Wealth Advisors. Pam, if you would.
All right, thank you, Fred. Everyone should have our presentation book in front of them, hopefully. My name is Pamela Thompson. I'm Managing Director for Mariner within Kentucky, coming from our Louisville office. We also have a Lexington office, joined by Eric Toll. The two of us are the managers for the investments that are within the pension plan. So the first couple of pages are just general firm update. We've not had any new updates. We were just here very recently, but our company does continue to grow. As a reminder, we are an independent registered investment advisory firm for you, which means we are a full-time fiduciary, and we are always obligated to do only what's in the best interest of the plan. So that's a very important distinction, and one that you should be very pleased with. We were ranked again last year in the top 5 by Barron's, the top 5 registered investment advisory firms in the country. So we're very proud of that, and want to make sure that you're aware of that. Page 3 is just kind of what we always have in here is the map of the locations that we have. Again, as we continue to grow, as you're out and about, you might see Mariner in more places. But the next page is our team, and you've seen that before. But let's go to page 5 is a summary of your investment policy statement. As a reminder, this is your document that gives us the basic guidelines by which we then manage the investments to make sure that we are in line with your objectives and that we're all on the same page. And so we like to review this just briefly. As a summary, the key aspect, probably the most important aspect of the way the investments are managed is the asset allocation. That's just what proportion is in the stock side of the portfolio versus the bond side of the portfolio. The target that you have had is 60% for stocks with a range of 50 to 80%. That is what we would consider kind of a moderate approach. It's one that gives growth over time that comes from that stock side of the portfolio. But because we can get volatility with stocks, we want to have a bit of a cushion. And so it's the bond side of the portfolio that provides that. So this is a good balance to give you both to make sure that the growth that this plan needs to live in perpetuity, to pay the benefits that are expected, it does need that growth. But the buffer of the bonds is a very important element. Everything else about the plan is to make sure that it is very well diversified, high quality. You can see some of those specific items. Individual positions shouldn't be more than 5% of the portfolio. Other areas such as international, and we have other restrictions on the amount in any one sector, that kind of thing. The full document is behind this summary. If there's any questions, I'd be happy to address that. We've had no changes, I think, in several years, so there's not anything new here. But if you want to turn to that next section of the book behind tab 2, we can get into a little bit of the market environment and then into the portfolio. But page 17 is just a review of last year. We're kind of keeping this in here for a while. The stock market was strong, and it was the second year in a row of a very strong market. Important to remember when we get into the volatility that we've had so far this year. But 2024, you can see, different kinds of stocks. They were all up to differing degrees. The U.S. was up the most, driven in the largest part by those very large technology companies, and that led to the difference between the S&P 500 and the Dow Jones, the red and the blue there. International was the lowest, although still positive. International stocks are represented in the yellow and the gray. But if you turn to the next page, it's interesting how that has reversed this year. So we have seen the benefit of diversification in the midst of much more volatility that we've had. The chart is just through the end of the quarter, so the end of March, but we've added returns to the right that show through April. Unfortunately, we don't have it through yesterday. If anybody watched the market, it was significantly positive yesterday. And all of this is a reaction and continued reactions to announcements about tariffs and the speculation of what do those mean, the degrees of those, what do they mean for at the economic growth of our country? Are we going to have a recession? Are we looking at higher inflation? What do the tariffs actually mean? It's like having a tax on a lot of different goods. What does it mean for the companies that are exporting, those that need to import their goods? So there's a lot of moving parts. It's not known what the end result will be. The good news yesterday was just that the China trade agreement had started to form, and it was looking like lower tariffs than what had been anticipated before. So that was very good news. Here through the end of April, which is the results that we have for you, so we'll keep things consistent. Through the end of April, we are still looking at a negative market for U.S. stocks. The red is the S&P 500, so that's what we think of as predominantly U.S. large cap. The blue being the Dow Jones Industrial Average, so down about 5% or 4%, depending on which one you're looking at, through the end of April, so just for that 4-month period. At the lowest, we had hit a point where stocks from top to bottom this year were actually down by 19%. I think that was pretty close to the day we were here last time. So we kind of keep having our meeting right after big moves in the market. What's interesting here, though, is you'll see the highest here through April, the yellow and the gray, were actually the international markets. So while we've seen several years where international hasn't done as well as the U.S., some of the way things have evolved this year have resulted in the dollar getting a lot weaker. A weakening dollar is actually favorable when you're investing internationally because those returns get translated back into dollars. And so a weaker dollar means you get more dollars from those returns from the international. So again, nobody likes the volatility, of course, but it is an important reminder of why we diversify a portfolio, because we don't want everything to move together. It's nice to have a few things that are actually holding up when some of these other things are dropping. So the diversification has really had a very helpful impact here. Couple other pieces, just a reminder on page 19, that it really depends on the period of time that we look at when we look at, okay, what are stock returns. So focusing on that right-hand side of the page where it's showing the S&P 500 since 1928, what it's looking at here, if you look at that very top line where it says daily returns, if we look at every single day from 1928 through the middle of last year, day by day, only about 52% of days were positive in the market. So you'd say about 50-50, day by day, whether it's a positive or a negative day. But as you go longer in the period of time, whether it's a month, quarter, 1 year, 5 year, 10 year, et cetera, the longer the period of time, the more predominantly positive those returns are. And that's just, I think, a very important reminder of when we're looking at investing in stocks, we have to take that longer term approach, because day by day, it's a flip of a coin. But those longer term, that's what we're looking for, is that growth long term that come from the stocks. And then one other just kind of commentary piece, again, with the volatility, just the reminder of how important it is to stay invested. We have some clients who feel like, wow, when it's so volatile, I just want to get out, wait till it's better, and wait till it feels better and get back in. This chart is one way to look at why we don't want to do that. This is looking at a 20-year period through the end of last year. If you were just 100% invested in the S&P 500 for that 20-year period, your return would have been that blue bar, which is an annual return of 10.35% per year on average. Out of that 20 years, if you only miss the 10 best days in the market, so the 10 best days out of 20 years, the return would have dropped, instead of 10.35% per year, all the way down to 6.13. That's a very large difference for what seems like a very small piece of that time, and to realize that, and a lot of the reason for that is why it's so important is that a lot of those very best days frequently come right after the very worst days. So a lot of times we get some of the big, super heavy, negative days in the market. Frequently, the very next day is when we're getting some of those best days, and so it's just so important to not get caught up in the negativity when those things happen. It's why we always talk about just the overall balance, and we want to make sure that that's still appropriate. But again, just an important reminder as we look at, again, that investing as long-term. And then a look at the bond market on page 21. This is just looking at interest rates. across bond maturities from 3 months out to 30 years. These are Treasury bond rates. The most recent set of rates is that dark blue line for April 30th. We are really kind of remaining in what we would consider nicer bond yields from an investment standpoint. So it is nice that we can now earn a decent return simply from investing in bonds with that very stable benefit that they bring, and earning that nice interest rate. Okay. We'll hand it over to Eric to go through the portfolio.
Okay. And we don't need to flip back, but to page 18, I think if we were to think about everything else that we're going to talk about, it really is hooray diversification. And that chart on 18 showing the returns of the various indices, international and domestic, what you'll notice at the end is that the internationals are starting to tip down and the domestics are starting to tip up. The point being, there's a reason why we invest and not trade, and that we remain diversified, because we can't make those timing decisions. And when everybody jumps on one side of the boat, it's just as likely that boat's going to need weight on the other side. So we remain broadly diversified per your investment policy guidance. And that's showing up here on page 22 with the overall portfolio performance summary. If I start at the top right corner and look at the total portfolio year to date, as of the end of April, it's down 1.8%, reflecting negative performance in the equity market of 3.3%. And again, remembering that the S&P 500 performance during that same period of time was down close to 5%. So again, diversification even within stocks. The bond portfolio, the fixed income, is up 2.8%, which gives us that total of down 1.8% for the year. So while it's been a very, we'll say, tumultuous first 4 full months of the year, your portfolio has held in rather well in very trying times. The 10-year performance average, if we look out over a longer period of time, the overall portfolio is averaged a positive 7.8% per year, with 10% per year coming from equities and just under 3% a year coming from stocks. So again, solid long-term performance designed to deliver on your objectives for this portfolio. Now, in terms of how that breakout is in that diversification, roughly half the portfolio is in large cap stocks. Another, call it 11%, is in small and mid cap domestic stocks. The international exposure is just under 9%. Commodities, so think gold, for example, is at just under 1%. And then core bonds is roughly a quarter of the overall portfolio. So with an equity value of a little over 16 million and a bond value of just under 6 million, you're looking at a total portfolio value as of the end of April of 23,381,000. A quick glance at the 2-year flow will show you that 2 years ago this portfolio was starting at $17.5 million. It grew to roughly $21 million in the calendar year 2023. By the end of 2024, it had grown to just under $24 million. And as of this year, we are at $23,381,000, so a performance loss of $612,000. Now, a quick look back at where we were this time a month ago, which seems like both yesterday and a lifetime ago, thanks to the markets. We've recovered a little bit of the lost value from where we were just post-Liberation Day in the performance metrics. I always find it instructive to go through just a refresher of how we break out the individual stocks, how we look at grouping and balancing your portfolio, again, diversifying the equity position. So the breakout that you see here is the way that we evaluate and look at individual stocks and cluster them into groups to give you proper balance. And so on the far left, you have are stable, consistent growers. The stable stocks that tend to identify themselves with not just a dividend, meaning rewarding their shareholders by paying them back in periodic amounts, but a growing dividend, which is a strong sign of a healthy business that they can not only pay and reward their shareholders, but that they can continue to grow that amount is a strong sign. It is also something that we look at, again, from stability, that we want to see less volatility than the overall market on average, sometimes equal volatility. That volatility is measured through beta, which is a relative number relative to the S&P 500 itself. In this case, the S&P 500 carries a beta of 1, so any number less than 1 means that it's bouncing around a little bit less than the overall market. So if we look at names here in the left-hand group, the more conservative, stable growers, you see yields that average 2%, and are growing that yield by, on average, 11% a year. That is strong cash flow growth that has to support that dividend growth, again, a sign of a healthy business. And betas, or risk measures relative to the market, of, at worst, parity or equal to the S&P in the case of PNC Bank, which I noted last time runs advertising calling themselves the boring bank, and so they're right at the S&P level, and Microsoft, which for those of us of a certain age think of a Microsoft as the core dividend payer, is a little bit odd, but nevertheless there they are. But you do find names like Kroger, Eli Lilly, again PNC Bank, PepsiCo, these traditional, solid, stable companies that form the left column in this group. In the middle, you have the cyclical growth team, and that team is the stocks that are participating in the economy of the time, that whatever the current economic trends are favoring, that is where the cycle is, or where the cyclical names are benefiting. So names here, as we continue to see growth in industrialization, in reshoring or friendshoring, in trends of bringing manufacturing back to the United States, you do see names like Eaton, like Baker Hughes, like United Rentals that will all take advantage of that trend. It is also a continuation and growth of the financial services industry. So banks like J.P. Morgan and Goldman Sachs will be in this group. This group identifies itself with a slightly higher earnings per share, although not dramatic, like you'll see in the next group, and a solid price to earnings ratio, meaning not too expensive, but not particularly cheap either. So the earnings per share growth in this group is averaging 10% a year, and the average price to earnings ratio is at 17. And then on the far right-hand side are the show-out companies, the higher growth companies that tend to make more of the news, particularly in the last few years. They're going to identify themselves with a more rapidly growing earnings per share level, and a little higher, if not dramatically higher, price to earnings, as investors are willing to pay up for the higher growth levels. So this is where you're going to find your Meta, your Amazon, your Visa, Uber, which we'll talk about here again in a little bit, and Nvidia. The average earnings per share growth in this category, again, is higher. It's 17, nearly double the cyclical group, and the price to earnings ratio is at 28. So again, higher because investors are willing to pay for the higher levels of growth. Now, we have certainly been in an environment over the last few years where higher growth has been rewarded more than stable growth. We're starting to see some of that shift, and as we do, because the benefits of active management, and about 69% of your stock portfolio is in active management, we have the ability to make shifts in where the weights of these columns are. And so currently you have more weight in the higher growth column. If we continue to see the economy and investment reward more of the stable growth group, then you'll see a heavier weight there. you'll always see representation in all three groups. But how that balances out, how the diversification works in your favor, will change over time. On page 25 are your top 10 stocks, and there's been some changes here from some of our previous visits. For a number of times, NVIDIA was at the top of this list, and it's still well represented, but Apple has overtaken it. And what I find interesting here is a couple of things. One is there is a heavy dose of technology names and high growth names. As we'll see on the next page when we get there, your overall technology weight's actually slightly under the market. So the truth is that the overall equity market is dominated by these names right now. We certainly are participating in them, but back to our hooray diversification theme, you're not entirely overweight these names. And there's a couple that I think are particularly interesting. One is Palo Alto Networks. Cybersecurity, no matter what happens in the economy, there is not a business out there that is going to slow down their spending on cybersecurity. So Palo Alto we consider to be one of the crown jewels of that group, also including CrowdStrike and Palantir. But that is a group that will continue to, we believe will continue to do well. And Uber Technologies, which actually is reclassifying its sector as in an industrial sector now, not technology. That shift should come soon. The continued growth of that through EATS, and as autonomous driving comes aboard through companies not named Uber, they'll be utilizing Uber's technology to keep those cars clean, to warehouse them, and to do the things for those cars while they're not actually out on the road, and so they're able to leverage that. They're able to leverage that business as well. As I mentioned, on page 26 is the equity sector breakdown, and the takeaway here is that at the top, technology at 29.25% is your largest weighting, and that is under the weight of the S&P 500. You are very well diversified through all of the sectors. Utilities at 0.1%, you would probably have to add exactly one more name to get it up to where the utilities weighting is in the actual S&P 500. So with very minor variance, you're diversified roughly in line with the overall market. There's no significant sector bets being taken here. As I said, 69% of your equity portfolio is actively managed. It is a very solid rule of thumb, if you can do it, to combine active and passive management. Over the last 36 years now, active equity portfolios have outperformed in 18 years, and passive portfolios have on average outperformed in 18 years. So having a combination, array diversification, allows us to weather whatever or take advantage of and participate in whatever the market is providing at the time, and not having to take an either-or approach. So you have the iShares growth portfolio, not surprisingly, is down 8.6% for the year, and the Russell 1000 Value Index is down 1.1% per year. But with 10-year track records that flip that over, the growth index is up 15% a year for the last 10 years, and the value index is up 8% a year for the last 10 years. The Russell 2000 Index, which is your small and mid-cap stock exposure, is similarly down a little over 11% for the year, but has a 10-year track record of up 6%. And the international ETF, the MSCI EAFE Index, is up 12.1% for the year, on an average of 5.5 for the year. So it is outperforming its long-term average. Folding all of these into your active portfolio has given you equity performance that is outperforming the indices themselves with a much lower overall risk profile and volatility. On page 28, you have the bond exposure. You are most heavily weighted, if not almost exclusively weighted, in the areas if we think back to the yield curve that Pam showed, where the value resides, there isn't much additional yield once you get past the 5-year, and particularly once you get past the 5 to 7 year range. There's not a whole lot of additional payout even today. So you're most heavily weighted in the high quality bonds that are really paying you the most value for the time being, particularly in that 1 to 3 year window is where you see most of your exposure. Between 1 to 5 years is almost all of your existing bond exposure. That may shift a little bit as we continue to see the yield curve settle, but that has been a strong position for the overall Lextran portfolio. Any questions on portfolio construction, diversification, or holdings before talk a little bit about the overall economy, where it's been, and kind of where we see moving?
Given how volatile Tesla is, are
Mhm.
you still, is this EPS consistent with what you're thinking?
Yeah, that's a great question. So Tesla is one that we've had significant discussions about. The volatility is certainly can't be dismissed, and it is a position that we've been reducing in portfolios, but not to the point of elimination. And one of the things that we've noted, given its varying business lines, that it really isn't the automotive company that was necessarily the primary when most people first got invested in it. And so as we continue to evaluate the other business lines, whether they're the autonomous driving, the continued growth of AI, whether or not it is worthy of holding, it certainly was I think a prudent decision not to sell out at its bottom, but we do continue to have active discussions about whether or not that will be an ongoing holding within our portfolios.
I'll also say it's, I can't think of the proper term, I want to say ironic that we're investing heavily in automatic driving, considering what we do for a living.
Yeah.
Notice.
Yeah, and I wouldn't say it's heavily, it's a very small position. Yeah. And I think a lot of it they view as, our investment team has viewed that as a technology investment, probably as much, if not more than just the pure driving part of it, but.
You'll have to understand, I see that as a competition.
Yeah.
Yeah, and if that's something that you would like to exclude, we can certainly do that. So we don't have a personal, like, oh, we have to have this stock. It's just just in the strategy that we have you invested in, the investment team has said, yeah, we think this has growth, but we can certainly tailor the portfolio for you if you would like
That
to.
will be a future discussion.
Okay, sure.
Anything else? On page 30, we'll start to do a brief economic review. The GDP officially contracted in the first quarter of 2025. It was an interesting read in that most of the components were positive, although slowing, and the change in net exports, meaning the difference between what we're importing and exporting, went suddenly and significantly negative, and that in and of itself in the GDP reading brought overall GDP mark to a negative 0.3%. There is just a reality of a business universe that is dealing with and trying to digest tariffs, whether that's front running and bringing in as much material ahead of that as possible, shifting supply lines and doing any number of things. So time will tell whether or not that this is a trend or it was just a blip, but it was certainly a negative reading in the first quarter. Along with that, consumption, which is the largest driver, was positive at 1.2%, but that is a slowing number. Business fixed investment, on the other hand, grew remarkably from a 0.4 average to a 1.3, which is a significant increase in contribution. Government spending, we'll say, went down 0.3%, so that was a drag on GDP. So overall, what we have seen from a economic standpoint, U.S. GDP standpoint, is certainly a slowing, and then a one currently outlier anomaly that we'll have to wait and see if it continues to be a trend in impacting overall GDP moving forward. Page 31 is just a review and education on expansions versus recessions. And one of the trend lines that we see over time is that the duration of recessions has been trending lower, and the duration of expansions has been trending longer. In fact, the last recession technically lasted 2 months. It was a blip after the longest expansion in recorded history. So we are, as of April of 2020, waiting to see how long this expansion lasts. Some of that will, again, as we look at the next month's GDP measure, will determine where we are. But the cycles have been lengthening out over the recent history. Page 32 is one of our favorite charts to review, and that's inflation. Inflation is certainly trending down. Remembering back all the way to June of 2022, when we saw a peak of inflation at 9.1%, our most recent reading was 2.4%, and again is trending down. We had seen a bit of a revival of inflation, and that seems to be breaking its way back down. Page 33, the Federal Reserve has begun to lower interest rates, although we are in certainly a pause and wait and see. They are doing what most of us are doing at this point, trying to digest as much data as they can so they can make the best decision as they can. But everybody's on a little, we'll say, uncertain footing at this point. On page 34, consumer confidence does impact the market. One of the things we know is, even in this last month, the retail investor has held in and has not sold out. Most of the volatility, most of the selling has come from the institutional investors, not from retail investors. A lot of that's driven from the fact that most people invest through their 401k, so they're not selling out, but that does have an impact. So does consumer confidence. And one of the things that we know, and we'll hit this here again in a little bit, is that when consumer confidence is at its lowest, has historically been one of the best signals to actually buy. That when people are pessimistic, they've kind of washed out their selling, and it's an opportunity to buy stocks at bargain prices and reap the rewards on the other end. So as we see on page 35, giving you a window into our process, we break down the overall market as well as individual stocks into these categories: fundamentals, valuations, and technicals. Now, I'm not going to break down each one of these individually for everybody's sake. But you'll notice the legend on the right, plus signs for positive, zeros for neutral, minus signs for negative. There are no minus signs in our view on the overall market. No straight negatives. In fact, no neutral negatives. Everything is neutral positive or neutral, with the exception of sentiment. Sentiment is the only pure positive signal that we have on this. Now, we just looked at a chart on the last page that said sentiment was at a low ebb. And that's because we see sentiment as a contraindicator, meaning that when sentiment's low, it's a great time for us to buy. So as odd as it seems, we'd be happier putting new money to work today than we were at this time last year when the market was in the midst of ripping another 25%. That's just how we look at it from a historical, technical trend. And what I believe has become our signature chart, page 36, is a review of the overall market and what historically happens in any calendar year. The typical year has a correction embedded in it. The typical negative intra-year return is negative 14%. Now, we tried last year. We got really close last year to a correction and just missed, but we were successful this year, as we all know. We saw the market down as much as negative 19%, almost bear market territory for the S&P, and then we've started to see a recovery. But just as a reminder that the vast majority of years, in fact 34 out of the last 45 calendar years, have been positive, and the vast majority of years have had a correction embedded somewhere in them. So, I mean, we remain investors and not traders. We remember that we're doing this for the long haul. Hooray to diversification, and I'm happy to answer any questions that you may have.
Anyone have questions?
And Laura, we are available if email, if you see something in review and something pops up, please don't hesitate to reach out.
Is there one reason you don't print the weight of the full listing of the stock investments?
We've just been saving paper, because it was so much paper to do all that. When we've got all this other detail, we just had stopped putting that whole report in. We can certainly provide it if it's something everybody wants to see. We just didn't spend a lot of time on it. Are you all receiving the statement every month? Because that should list every holding.
Yes.
Okay.
There's no such thing as too much information.
Oh, yeah, we're happy to provide it. Yeah, and that's why we're happy to take any feedback on the report structure and what you'd like to see. So, just, it's a lot of paper to print if nobody wanted to see it, so. Would you like us to start including that again?
Yes, please.
I'm sorry?
Yes.
Yes, okay.
Any other questions for Pam and Eric? Hearing none, thank you both for your report. On our agenda, we can now go back up to the second item, which is approval of minutes. We now have quorum. So has everyone had an opportunity to review the minutes for April the 3rd? Any corrections, comments, clarifications? I'd like to make a motion to approve.
So moved.
Second? Do you need a moment to read them? We can wait.
This motion is to say members of the collective bargaining unit instead of agreement.
You on page 2? Okay.
Okay, that's second line. Pension plan to say members of collecting bargaining unit. Agreement becomes unit.
Yeah.
Any other comments, corrections? So we have a motion and a second. Okay, all in favor with that correction, please say aye.
Aye.
Anyone opposed? All right, motion carries. Next item on the agenda is the actuarial report from Osborne, Carrero and Associates. We have Mr. Steve Osborne here with us. So Steve, please take it away.
Thank you. You have my report, which is this brown or beige report right here, and I'm going to go through a few pages at the front that are also page. The rest of the report I probably will not go through unless there's questions. It's just summary and information that details some of the items that are summarized in the cover letter. So on the very first page, this is a calculation as of January 1st. This is done once a year on January 1st. There's 3 columns. The far right-hand column, the most recent information. You can see that the number of people included is up to 356. I think we're paying in the neighborhood of 78 retirees each month. The bulk of this number are working people that are still working here at Lextran, and there are some people who have quit that are due a vested benefit when they reach their retirement age. The assets at the end of the year were $23.8 million, and there was an investment return during the year of, I believe it was 14%, which was 14% better than what I saw in general, so that was good. And at the bottom right-hand corner of the first page, there are contribution levels expressed in terms of cents per hour, because that's the way you pay for the fund. As of July 1st, labor's putting in $1.22, and so is management, for a total contribution of 244 cents an hour. The actual recommended contribution rate is $2.38.2, so right in line with what's being contributed. And that's not really an accident, because when you talked about increasing the benefits last year from $50 to $60, it was determined that that's really, after the change in the contribution rate in July, that's what the fund could afford, and that's still the case. On page 2, there are 3 sections: the current status of the plan, just some commentary again that I'm presenting the cost in terms of cents per hour, because that's how it's funded. The plan is in good shape. Changes since last year, there were mainly 2 changes. The first one was that the benefit was increased from $50 per year service to $60 per year service. And the second big change was that the fund had a 14% investment return. So if we're assuming long-term that we're going to get 6 on average, then when we make more than 6, the fund has a gain. Now, when we make less than 6, then we have a loss. So you could have it either way. 6% we think is a decent assumption. We believe it's on the conservative side. And as a result of both of those items, the fund is still more than 100% funded. We have no unfunded liability. The bottom section and going into the top of page 3 is a cost to change benefits. I think we were asked specifically what we could change the benefit rate to, and right now it's $60. There's a typo, and I think that 50 at the bottom of page 2 has been marked out to say 60. And that's on me. I'm sure I typed that myself. We looked at what it would cost, and when we look at what it costs to raise that $60, we are assuming that that applies only to people that are still working here. It wouldn't apply to people already retired, and it wouldn't apply to people that have quit and are vested. Just people here that haven't retired yet. So a $10 increase, I'm at the top of page 3, would raise the recommended contribution by $1.02 per hour. And that's proportional, so that, for example, a $20 increase, that is twice $10, would cost twice what a $10 raise would, or $2.04. And conversely, a $5 increase, that is half of a $10 increase, would cost half of what a $10 increase cost, or 51 cents. So in the next section, what we could afford is essentially $1, raising it from $60 to $61. That would raise the recommended contribution to $2.42 compared to the $2.44 you're putting in right now. I do want to say, an actuarial projection is just that. It's a projection. It's not a guarantee. There's a lot of areas of risk involved in a pension plan, or another way of saying that, there's lots of things that could go wrong. There's things that could go right as well. Your biggest area of risks are the investment returns and the hours that you work. The investment return, we're assuming 6%. If you actually had a 0% return, the recommended contribution rate would over time increase by about 70 cents an hour. If hours fell to 300,000 a year, the recommended contribution rate would go up by about 16 cents an hour. Now, obviously the investment return depends on a whole lot of things that are completely out of our control. You know, the market in general, the economy, the hours are somewhat under your control, but you know, the hours also depend on the demand for ridership. And so that's also another area of risk. And the rest of the report, again, there's 8 exhibits. Those are, you can look at them, they are not required reading, but they just detail of information that I've summarized here in this letter. And I'd be glad to, well, before I take questions, I know in the last meeting, Todd asked about what changes in the market value, how that would affect the benefits. And a decrease in the assets do not directly affect anybody's benefits, because the structure of this plan is, if you retire, you're guaranteed $60 times your years of service, regardless of what happens to the market in the meantime. Impacts on the market, changes in the market do impact what you need to be putting into the plan to make the whole thing work. So they don't specifically affect an individual's benefits, but they could affect, you know, how much money you got to put into the future, or what kind of raise you could do in the future. And with that, I will stop and see if there are any questions.
Any questions for Steve?
The $1 raise that is based on, is that the median, or is that how do you determine the $1?
So if you're putting in $2.44, I said, well, how much, what is the most I could do, and the cost would still be $2.44 or less? And it was $61. Now, Eric, I rounded, I looked at 50-cent increments. I didn't look at, you know, that it could be $61.06 or something like that. $61.50, put it over 244, 61 was under 244 an hour.
Asking because I do not know.
Nope, no, it's cool. And of course, if you think of questions later, that's fine. I'll be around.
Any other questions for Steve? Okay, thank you, Steve. Next item on the agenda is old business. And last meeting, there were 2 items that were brought up that could potentially lead to amendments to our pension plan document. The first, we'll walk through each of these individually. And we asked both Addison and Steve to help us work through both of these. The first is Article 3, which is the language that defines collective bargaining unit or union employee. I think the spirit of this is to make sure that everyone is, in fact, required to participate in the pension plan. Is that a fair assessment?
Yeah.
Okay. Addison or Steve, would you all like to share your findings on this question?
Basically, we kind of came to the same thought that if the collective bargaining agreement, if you guys want that to say a certain thing, we see no problem with amending the pension plan to mirror that.
So just with the language of
Although
how,
I'm haven't been able to find any place where it actually says that part-time employees are not included. I'm not sure. That needs to be in the contract or not.
that I don't know, but we can look into it.
Seems like there was language in the plan document, not in the bargaining agreement, but in the plan document that limited it to employees that are full-time.
And a similar question came up a couple of years ago for admin, whether or not admin were required. And the legal review on that was the same. Yes, admin are required to participate in the plan. And I think the same thing held true when we looked at it for bargaining employees too. Regardless of their status in the union, they still are required, the way that it's written now, to participate.
So we'll know why we're part-time.
Part-time, I don't know. That we can look into and see if there's something in the document itself that excludes them. We did not look at status between part-time and full-time. But we can certainly do that.
Also, just one little thing, circle back. I'm looking at the expenses in Exhibit 3. Why is it triple? And B for administrative, what are they triple?
There was something new that hadn't been paid for before.
For the timing of an invoice.
Yeah. Eric, I looked at that too, but that was back before May 7th, so I just don't remember right now.
Pam, that's the one we looked at with that Mariner invoice that,
Oh, is that, yeah, because we had issues with US Bank not paying
Yeah.
some of the fees, and it got figured out in the next year.
Yep.
And so it was payment of fees for our part of it.
There was, yeah, because the 5,000 all before was me. And then there was a $10,000 additional, and I don't recall who that was for. Is the bank charging 2,500 a quarter?
they do charges per quarter, but I'm not sure what it is. I can look-
That's what that is.
I can look it up.
That's a big job.
Yeah, I thought it was something that hadn't been being paid out of here before.
I'll look it up.
Is that also one of the reasons why the ratio of assets to annual expenses has also climbed significantly, or?
No, the reason that has climbed so much is because the assets are up. Because they had that 14% return. Plus you're still, putting in money.
So Addison had noticed on page 7 of this document, Exhibit 6, which this comes directly from our pension plan documents, right, Steve? This language
Yeah.
here?
Well, I don't know that it's verbatim
Verbatim.
language, Fred.
Okay.
I've summarized the way we understand it.
So does say an employee that all regularly and continuously employed on a full-time basis? So somewhere in the pension documents probably says full-time.
Yes, that's most likely the definition of what an employee is, and that's how we would use it throughout the whole thing.
I would like that double check.
Yeah, we'll
because
double check it.
The gentleman said he was not sure if that was the exact language.
Yep, we'll double check it.
Under participation, it doesn't match.
And that's the second question that we came out of last meeting. How do, or when should employees begin their participation in the plan, begin their contributions, and to make sure that that is fair? I think at issue was some employees, if they're management side, have a different set of rules than if they're the union side. And they get the same benefit at the end of the day.
Yeah.
It is written that the plan should mirror the CBA. The changes in the CBA over time, especially this last one where we went from hours, or went 2 hours for probation, means that it's even more confusing as to when employees would begin their participation. So I don't know if you all want to speak to that question, of whether do we have to use probation to be the determining factor when your contributions start?
We're not actually doing that, so, the probationary period is 90 regularly scheduled, or was till the new contract was 90 regularly scheduled work weeks. So if you work a 5-day week, 5 days each week count towards your probation. If you have a 4-day week, it's 4 days. So when I was hired in 2019, my contribution started 90 calendar days from hire, which was long before my probation was over. But it probably mirrors what is happening on the admin side. So when I stepped back and looked at it, I think, well, that sounds fair to me, that we all pay the same, start paying at the same time because we're all getting the same benefit. When I talked to employees that started after me in 2022 and 2023, their contributions started roughly 90 calendar days from their seniority date, which is still well before the end of their probation, which is what came up, which was what prompted me to bring it to bargaining, is that they're asking me why am I contributing to the pension when I'm still on probation? Because some of our language that's been put out in different places has been kind of all over the place. You know, it refers to probation sometimes in relation to the pension plan specifically, and then they say, well, no, I'm still on probation, so it doesn't. That's just kind of cleaning up the language thing. So I guess one question I have is, like, is the committee responsible to make sure the plan is followed? Is that our job?
Well, no, I think that would be the pension administrator. I think that would be more Steve's job to make sure the plan's followed, right?
Yeah, I mean, part of my job is to, like when we calculate the benefit that a person gets when they leave or retire, is to follow the plan. The plan document itself will say who is the legal administrator who has responsibility to make sure the plan is followed, and that may extend, I'd defer to Addison on that, to this committee. But getting to your question of when a person can come into the plan, you can pretty much do whatever you want to do, so long as you don't make them wait more than about a year.
So I think we can clean that up.
That definitely needs to be cleaned up, because what you're saying is you don't know if you were in charge of the plan either, is what you just said.
Well, I'm saying that there is in the plan document, there's a person who is defined, or a group that is defined, or an entity that's defined as the administrator. And it's not me. I mean, as my function being contracted to the plan, I do have to follow the plan.
But he's there to analyze the risk and.
The administrator of the plan is me.
You're the administrator? Okay.
And everything I do, I go through Steve.
Yeah.
Okay. I would just like to know the chain of command at this point. Clarification always helps figuring out where things need to be addressed.
Yeah. No, I'm in a lot of trouble if you don't follow the plan too, so.
I understand. It's more of a situation of, I think Laura, if I'm wrong with these, trying to figure out who's in charge so we can figure out how we can, at the very least, get things running smoother. Got it? Fair enough statement?
Well, I just don't understand why you would have a plan and then not follow it. It's odd to me. Like, who's responsible to make sure we're doing things the way the plan says, or making sure the language gets corrected to make sense within, you know, the CDA or whatever we're doing. Because we haven't been doing it for at least since 2019, probably long before me. But at the same time, when I step back, I think the way they did it for me is actually what's most fair to everybody. But that's a big change, so we should, we should talk about it, not just today, is how should it be done? And, there should probably be a lag time between the time you get hired and the time you start contributing, because otherwise it could create a lot of refunds, especially for the unit employees. There's a lot of turnover, a lot of attrition, but I don't know that it has to be our actual probationary period, which in terms of that, we would just need to make sure we're clearing up the language, make sure it's very clear to everybody. This is like a trial period. It's not your probation period. It's 90 days from hire, 90 days from seniority. If we do it 90 days from seniority, is that fair to the admin people? Because if they're paying in 90 calendar days from hire, they're paying more and getting the same benefit. Do we want to do that in the future?
What we
Is that-
found is that we don't have to link this to a probationary period.
Yeah.
We can come up with what we, or what the committee feels to be fair. And that's something that we can discuss and take care of today, if that's what the committee chooses to do.
I would like to see 90 days from, 90 calendar days from hire date for everyone.
That's how it was done for me. And at first, I was looking at it just in terms of contract language, I was going, well, this isn't right, and many times I pay everybody, this is a whole lot of money. But the more I thought about it, the more I thought, well, how's it done for them? It wouldn't be fair, I think, I mean, do you think attrition-wise, 90 days from hire, we probably still lose a good number. I don't know if that's a problem from your end, because then you have to give a refund.
Yeah, I just have to do refunds. But it would be much easier administratively to do 90 calendar days from hire date. That way, every single person is on the same schedule.
I think that's fair.
Is it better, I mean, right now, under Exhibit 6 on 7, it says basically that of continuous service following the month, the first day of the month after. It's kind of like health insurance, would it be better to follow it that way or just from the higher date itself? Does it really matter?
Doesn't matter.
I mean, you're talking, 15, 20 days difference. If somebody was hired on the 3rd versus I'm just, if you use the same kind of process that you use as someone who's eligible for health insurance, which would be the first day of the month after they get hired, which would start their 90-day thing. Just a thought, just thinking out loud.
The flat 90 is fair and reasonable.
And Addison, is this a situation where if the committee decides to move on this, they would direct me to take it to the board?
Yes.
I think that's fair. It would be a change for the people coming in now, so they'll be paying a little earlier. They won't know it because it's not like it happened twice, so the people, new people coming in will be like it was, I guess, before Nikki came in. I think she said since 2020, but certainly in last year, 2019, so it was a different way probably for those people. So it'd be reverting to that, I think. I think it should be the same for everybody. I think that's fair. What do you think, Joyce?
Let me say, is this something the committee wishes to move on? Because if so, I'll start to try to word this.
The wording part's
I'll do the
not-
wording part. I just want,
Oh,
like a
okay.
straw poll. Is this something that we ought, that we
Okay,
want to
yeah.
do?
Yeah.
Yeah.
Whatever works for everybody.
Okay. So the motion would be that the committee directs me to bring an amendment of the pension plan before the board of directors that would establish pension contributions begin for all employees following 90 days from their date of hire.
90 calendar days from the date of hire.
Did I get that
Make sure you say calendar.
calendar?
Yeah.
Do you want me to write it down?
Please.
I got it written down.
Does that capture what we're talking about? Okay. So, I'm not on the committee, so I can't make that motion. I'm gonna need
I'm
one of
happy
you all.
to.
Paul's got the motion. We need a second.
Second.
Do you want to read it one more time before we vote?
1 second.
All right. Read us the motion on the floor, please.
The motion on the floor is for the committee to move the executive director, Fred, to bring a motion before the board of directors to amend the pension plan interest document to read that all employees will enter the pension plan 90 calendar days from the date of hire.
Everybody good with that? All right, all in favor, please say aye.
Aye.
Anyone opposed? All right, motion passes, and I have homework to do, right?
Yep.
All right, very good. I think we have plenty of time to get that on the agenda for May, so we'll look for the board to vote on that in May. Are we all satisfied on the first thing that we talked about the definition of bargaining unit employees, that everyone is required? Do we think there's any action need to be taken there? Are we good?
Again, I just want to clarify for certain that
Clarify.
part-time are not included in the actual language.
So on new business, we'll move that part-time is excluded. We have the change in administrative fees that we need clarification on. Those are the two big things that I have. Oh, and the adjustment of your report to show all of the held equities, stocks and equities. Anything else for new business? Oh, sure.
Welcome to aging.
It's just looking for the definition, but it might take me a minute, so.
Okay. Any other new business? Committee? No. Okay, our next meeting is August the 12th. If there's no other questions, comments, concerns, topics, we stand adjourned. Thank you all.
Thank you.
Thank you.